Hi everyone, welcome back to chapter 6. Chapter 6 I consider as a very challenging chapter. The reason is revenue recognition, although it sounds very easy and or it's just when you deliver the products or you serve the clients. But little did we know that there's so many complications in the revenue recognition to extend that. FASB actually published a new rule in 2016, and in nutshell, it consolidated hundreds of industry practices into a general revenue recognition. But even with that, this is gonna be the new version of how to recognize revenue recognition. Even with that, it's still very complicated. And you guys will see after you learn this chapter. But this challenge is good news to you as well, because after all these complications, in the end, your ability is grown, right? So, in nutshell, we will focus on the revenue recognition, which determines when and how much revenue appears in the income statement. So, income statements, the most important thing is the revenue, right? So, hence that this is the most very critical thing to know how to conduct. And in part one of this chapter, we will discuss the general approach. And then and for recognizing revenue in three situations. Okay, and first situation is at point of time, means that the performance duty and obligation is completed at the one point of time. Okay, and the second scenario is over a period of time, right? So it means that your revenue generating ability or obligation has to spread over a period of time. And the third thing is we're going to look at the contracts that include multiple parts, okay, and that might require recognizing revenue in different times. So that will generating a trigger point to recognize revenue at different point in time. Okay, this is a part 1, part A. Okay, and part B, we're going to talk about special issues that affect the revenue recognition process, such as consignment and warranty and stuff like that. And then part C, I consider is more challenging. We will discuss a long-term contract. I remember when I was taking CPAs, this part took me a while to get it, and that was before the revenue recognition new rule adopted. After the adoption of new rule, this part become more complicated, and I think we needed to do this because it will be absolutely on your CP exam. So relatively, part A is relatively easier, and part B become more detailed, and part C is more complicated. And I will teach this in 2 weeks, right? So this video gonna record probably more than 1.5 hours for each video, and there will be 2 videos in total. I don't want to dice up too much. That way you feel like you cannot follow which part and which part. So I just do it two videos at most, at least 2 videos, at most 3 videos. Okay, now I just plan to do 2. Okay, so first of all, why is such a simple concept drive everyone crazy? So in nutshell, okay, revenues are inflows and or other enhancement of assets of an entity, or settlement of the liability, or combination of both from delivering and producing the goods, rendering services or other activity that constitute the entity's ongoing major central operation. There's several points here, right? So first of all, it's the inflow of resources or enhancement of inflow of cash or increasing of certain assets or decreasing of liability, right? Essentially, revenue you have to link with the revenue lives in the income statement, but in reality, it's basically you have to tie with what is the balance sheet effect of revenue in revenue recognition, right? Or a combination of all three, or any kind of combination with either two or three of them. And then the objective is trying, the reason those things changing is because you render your major services, major operation services, right, or products. So what is your major operation is, and then you render that operation to generating your own revenue, okay? And the measuring and reporting revenue is a very critical aspect of financial reports, that's for sure. And it's important to not only determine how much to recognize the revenue, and but when to recognize the revenue is very important. So in other words, what is dollar amount is important, and what time you recognize the revenue is important, right? Okay. So prior GAAP is actually using a philosophy called the realization philosophy. We call it realization principles. It required that the revenue to be recognized when both of the following criteria are met. First, the earning process is virtually completed, and there's a reasonable certainty that the collectability of the asset to be received. And this principle is quite difficult. The reason is that it's really hard to determine what is the virtually, how do you virtually decide when is the earning process finished, right? At the same time, how do you measure collectability, and how do you define certainty of the collection is? So these two criteria is quite vague, at the same time hard to nail. And so therefore problems with applying realization rule is that the revenue recognition was poorly tied to the FASB conceptual framework, which is based on the balance sheet, right? Tied to how does the asset or liability or equity changes. And second of all is a focus on earning process led to similar transaction being treated differently in different industry. Like I said, use the old realization rule, there's hundreds tons of guidance for different industry about how they recognize revenue, which supposed to be similar, right? Because everybody is making the money the way that it should be. Why different industry is having different guidance? And third, it's difficult to apply complex arrangement that involve multiple goods and services commingled together. Okay, so therefore, there's a new revenue recognition standard issued by FASB, and as I said, it's in I think it's 2016, and the accounting standard called ASU updates, right? Number 2014-09, revenue from contract with customers. And it provides a unified approach that replaced more than 200 different pieces of specialized guidance that had developed over time in US GAAP. In other words, the old realization rule is like a band-aid. Okay, this time I don't know how to recognize it. Okay, there's a new guidance. Another time this is special activity that I don't know how to do it, and then issue another guidance. So that becomes like, even the essentially is the same essence of the business, but the way they recognize it so wicked and twisted, you know. So and then FASB saying that, okay, you know what, let's use a clean slate of a board and let's start all over again to think about what is the essence of revenue generation, and how come up with a philosophy that can comprehensively help people to recognize revenues. Okay. And then this wonderful glory core principle is that company recognize revenue when goods and services are transferred to the customer for the amount of company expected to be entitled to receive in exchanging for those goods and services. There's 2 points here. First of all, it's only stress transfer, right? So when you transfer the stuff that you meant to transfer, you can already recognize revenue. Second of all, at the same time, you expecting such transfer can give you money. Entitled, so the seller who transfer the products to the customer, knowing on the condition that they are expected to be paid. So this two thing is good enough. You first of all you transfer the control rights and titles to the customer. At the same time, you know that such transfer is not a gift. Is you entitled and you expecting to get paid. So in a nutshell, when means that up on transfer, how much amount that you expected to have. Okay. Okay. So then we wanted to introducing 5 steps to recognizing revenue. First of all, we wanted to identify the contract with customer. And second, we wanted to identify the performance obligation. So what kind of things I need to do to be considered transfer the products to the customer. 3 is that we wanted to determine each steps or each action that I carry out or each product that I transfer, what is the transaction price associated with that action. Okay. And fourth, I want to allocating those transaction prices to the action that I did, either a point in time or over the period, right? I wanted to allocate the transactions that can help me recognize revenue in a timely fashion. Number 5 is to recognize that revenue when each performance obligation is satisfied. So there, first of all, you identify contract, understanding what you are trying to do. Second, you wanted to separate each transactions item into a performance obligation. And then you find that each obligation's price, how much that obligation worth me to do. And then you allocating that obligation pricing based on what you have done. And then you recognize that obligation as a revenue. Okay. So, and then regarding these 5 steps, and there's first of all, what we're stressing the identify the contract is that the seller are legally protected. So there's legal rights between the seller and the customer has been established in that contract. And when we identify performance obligations, there's a single obligation versus multiple obligation. In other words, that you can providing one product or multiple product or over a long period of time of product to the customer, being considered that you performed the obligation. And then determining the transaction price means that if you are single performance obligation, then the amount the seller is entitled to receive from customer. Once this single obligation is associated with the amount the seller is entitled. If you have a multiple obligation, then amount the seller is entitled to receive as well. The allocation of transactions, there's no need to allocate because you only have a single obligation. But if you have a multiple obligation, then you need to allocate the portion to each performance obligation, right? And then under the single umbrella, when we recognize revenue, we can recognize at the one point in time. Means that at 12 p.m. today, I recognize this revenue because the obligation has been fulfilled. Or I have a single transfer duty, obligation duty, but that duty is carried out over a period of time. Hence, over a period of time, I recognize my revenue. And the last one, the multiple obligation meant that at whatever time it's appropriate for each obligation is performed, then you can recognize each obligation, performance obligation. Okay, this is very kind of like abstract, so we will have a very specific way to learn this chapter. Okay, so which of the following is not a step used to apply the core principle of revenue recognition? Determine the transaction price, definitely. Identify performance obligation in a contract, yes. Identify contract with a customer, yes. Ensure the sales price is fixed, no, this is not, right? So D. Okay, so first thing we want to learn is remember a single point in time recognition. So So indicators are used to determine when the control has transferred from a seller to a customer. The good thing about this kind of transaction is that there is an indicator that we can use to determine whether the control rights has transferred to customer. A customer are more likely to control a goods or service if customer has several things that we can identify those indicator. What are those indicator? First, an obligation to pay the seller. Okay, that means that the control right has been transferred. Two, a legal title to the asset. The customer has the legal titles already. Three, physical possession of the assets. Right, all these things is emphasize one thing: transfer. And then how do we define transfer? There's so many different ways. So here are the 5 ways. Obligation to pay the seller, legal title is held by you as a customer, or physical possession of the assets already, or assume the risk and the rewards of the ownership. So you already take over all the risks and the rewards of the assets that being transferred to you. And then 5, you have already accepted the asset. So this 5 indicator means that the seller has already accomplished the performance obligation, and then seller is entitled to recognize that revenue. So let's look at this one. TrueTech Industry sells Treebox, a gaming console that allows user to play video games individually or in a multiplayer environment over internet. Treebox is only a gaming module and includes no other goods or services. When should the TrueTech recognize the revenue for the following sale for 1,000 Treeboxes to computer stores? So December 2020, computer store orders a 1,000 Treebox at a price of $240, promising payment in 30 days after delivery. So computer store is the customer here, and TrueTech Industry is the seller, right? So they only ordered 1,000 the Treeboxes, which is the product, and then at $240. Hence, there's nothing need to be recognized. There's no transfer of the title. There's no the 5 indicator, right? However, on January 1st, the TrueTech delivers. This is a big word, transfer, right? Delivers 1,000 Treeboxes to computer store and titles to the Treebox transfer title transfer to the computer store. So then this is at the point in time we recognize the revenue. So because they say they are promised to pay within 30 days, so it should be recognized as accounts payable. So therefore we debit accounts payable and we're crediting a sales revenue. Okay, on January 25th, TrueTech received $240 from the compute store, and then that's easily just debiting cash and crediting accounts receivable, right? Okay, so which of the following is not a key indicator used in deciding whether control has passed from the seller? Seller can identify the contract with the buyer. That's definitely not, right? This is the first step in the revenue recognition. But the last 3 of buyer has obligation to pay, buyer has a legal title, buyer has a physical possession. They are all considered as the transfer of control indicator, right? And okay, and which of the following is not an indicator that control goods has passed from seller to the buyer? Okay, this one is buyer has an unconditional obligation to pay, and buyer has a scheduled deliver. Buyer has assumed the risk and rewards. This one is the obligation to pay, and C is the wrong one, right? Okay, sorry. Okay, so recognizing revenue over a period of time. So this is the second scenario that we wanted to learn, which is recognizing revenue over a period of time. So revenue is recognized over a period of time if any of the following 3 criteria has been met. So in what kind of scenario that we cannot recognize revenue at the point of time, but over a period of time? There's possibility. First of all, the customer consume the benefits of the seller's work as it's performed, right? So such as the cleaning services, it takes a while to do it. Hence that the revenue recognition has to take in a period of time. And second thing is that the customer controls asset as it's created, such as you're constructing a building extension, right? So the consumer has already controlled the asset while the seller is creating the product. And third scenario is the seller is creating an asset that has no alternative use to seller himself. The seller has a legal rights to receive the payment from the progress to date, such as an order of jets customized by U.S. Air Force. So the commonality of the three things is that the customer has already either consumed the benefits or control the asset, or already the product has no other use to anyone else but the order itself, the customer himself. So in other words, over recognizing revenue over a period of time emphasize one thing: the creation process by the seller is contemporaneously happen with the customer's enjoyment of the benefits, right? And that's when the revenue need to be recognized over a period of time. And when the revenue is recognized then how do we do that, right? The revenue should be recognized in proportion to the amount of a performance obligation that has been satisfied. Means that if it takes 1 year for me as a seller to complete my performance obligation, because while creating it, the customer either controlled the asset already or already consumed the benefits, such as, let's say, constructing the building, then I can also recognize the revenue on monthly basis if I wanted to. That means that based on my progress of completion, okay, I can recognize debit, accounts receivable, and crediting revenue while my completion percentage of the building has been performing. Okay, I don't need to wait until the end of the year to recognize my revenue. Okay, so let's look at this one. The TrueTech Industries sell 1 year of subscription to the TrueNet multi-user platforms of internet-based games. TrueTech sells $1,000 subscription for $60 each on January 1st, 2021. So first of all, this TrueNet multiplier is a customer, right? I wish they use a different name. TrueTech, TrueNet is confusing. Okay, TrueTech is the seller, right? So sellers sell 1,000 subscription of playing video games to a customer, right, for $60 each on January 1st, 2021. Immediately, the TrueTech will recognize a cash recipient of $60,000 and a crediting deferred revenue. Deferred revenue is because the TrueNet customer has not enjoyed the benefit the subscription provided yet. It's at the beginning of the year, hence that you defer that revenue by crediting the deferred revenue. And at the end of each 12 months following the sales, the TrueTech would recognize the following entry to recognize the subscription revenue. This is we learned in financial accounting, right? It just wear a different hat, different clothes. So we will recognize in month by month the $5,000. The 5,000 equals 60,000 dividing 12, right? Over each month, and we can by debiting the deferred revenue and crediting services revenue along the way. Okay. So how do we recognize revenue when three criteria does not apply? So if a performance obligation does not meet any of the three criteria that we talk about for recognizing revenue over time, then we will recognize revenue at the point of a time when the performance obligation has been completely satisfied, and usually occurs at the end of the contract. So basically, the three criteria we talk about: the customer already enjoy the benefits of the creation, or the customer enjoy the control right of the creation, or the production itself has no other use but for the customer, then we can recognize revenue over a period of time. However, if we cannot find these three criteria in the essence of the contract, then what we will do is we will wait everything has been performed at the end of the contract to recognize the revenue at one point in time, like the first way we did in the recognizing revenue. Okay, and then determine progress towards completion. This means that we wanted to recognize revenue over time. A seller needs to estimate the progress towards the completion, right? And then there's two possibilities you can do that. One is you based on your output. Another way is you based on your input. So output based, how can we do that? We can measure as a proportion of the goods and services that transfer to date. Means that we look at what you have done as a seller, and then to estimate what the completed product look like and how much that has been completed. Another is the input-based estimate, means that I measure the proportion of the efforts that I have spent thus far related to the total efforts that I expected to satisfy the performance obligation. There's two concepts. One is that based on what it should look like in the end, and I proportionally recognize what it is now and what it is before. And then also the input base is that I estimate how much effort that I need to put to complete this project, and now I look at how can I recognize the revenue. And then next thing we see is recognizing revenue for contracts that contain multiple performance obligation, right? Remember, there's a two category. One is we just recognizing one obligation, single obligation, right? And then next thing we wanted to learn is to recognizing the contracts that contains multiple performance obligation. So first of all, if we suspect a contract has multiple performance obligation, step 2 and step 4 of the revenue recognition process, it comes to play, right? So first of all, we have already learned identify contracts. Second thing is we wanted to identify the performance obligation S, right? There's multiple obligation performances, okay? So step 3 is determine the transaction price. Step 4 is allocate the transaction prices to each performance obligation. So this is the interesting part. And step 5 is to recognizing revenue when each performance has been satisfied. Okay, so recognizing revenue for contracts that contain multiple performance obligation, we wanted to learn most importantly step 2 and step 4. So step 2 saying that identify performance obligations, right? So sellers account for a promise to providing a good or services as a performance obligation if the goods or services is distinct from other goods and services in the contract. Meaning that we got to able to find out what's the distinct performance obligation, then we can understanding how many the obligation there is, right? So for example, a good or services is distinctive if it both satisfy two criteria. First, is capable of being distinct, right? Of course, if it's if the obligation including the transfer of products plus transferring services, I can clearly identify what's the difference between a product and services, right? Okay. 2, I can separately identifiable from other goods and services in the contract. What if there's multiple products and multiple services need to be delivered to be considered completion of the contract? That means that I not only can identify the product itself and the services itself, I can also separately identify the product with other products and with other services. For example, if you go to a spa, right, you wanted to do a facial, so that's and at the same time they're gonna give you some masks. So mask itself is distinct the product. At the same time, the massage and the treatment itself is the services that can distinguish from the products that they use and give to you, and also the services they performed on you, right? So example of a failing the separately identifiable criteria such as the construction contracts. In other words, if the construction contracts has it's really hard for you to identify uh, it's really hard for you to identify which part of the construction is identifiable products versus the other. The whole thing is the construction itself. Okay, so let's look at this question. The contract containing multiple performance obligation. TrueTech Industries manufactures the TrueBox system, a multiplayer gaming system allowing players to compete with each other over internet, right? So basically, the TrueTech, the manufacturing the boxes that can help the players to play with each other. So the TrueBox system, including a physical TrueBox module as well as 1 year subscription to TrueNet multiply platform of the internet-based gaming and other application. So basically, when the TrueBox sell to the customer, they sell two things. One is the TrueBox module, that plastic thing. At the same time, you have to subscribe to the TrueBox system to be able to use it. So the TrueTech sells the individual 1 year subscription to TrueNet for $60. So the subscription itself worth of $60, and customer can access the TrueNet using TrueBox as well as other gaming modules, right? So you don't need to have to buy the plastic player thing, the operator from TrueBox. But you can use other kind of module to play, but the subscription to the website is $60. And TrueTech sells individual TrueBox module for $240. So the module, so the plastic operator is $240. So customer can use the TrueBox to access TrueNet as well as other multiple gaming platform. So that module itself, so the plastic operator can also use to play some other games as well, okay? But as a package, here's the trick. As a package deal, the TrueTech sells TrueBox system module plus the subscription for $250. So in other words, if you're buying them singularly, it's a $240 plus $60. It's gonna be $300. But if you buy two things at the same time, it's only $250. So here's the scenario. On January 1st, 2021, TrueTech delivers 1,000 TrueBox systems, which is the two things together, right, to the comp store at the price of $250 per system. And TrueTech received $250,000 from the compute store on January 25th, 2021. So first of all, do we have a contract? Yes. Second, identify the performance obligation here. So first of all, we have a good and the services is distinct, right? If both the capable of being distinct and separately identifiable from other goods and services. So the TrueBox system contains two distinct products here, right? One is the TrueBox module, which is a physical product, and then is a and the second one is a TrueNet subscription. It's a services, right? Services is over a period of time. So therefore, a TrueBox system including two performance obligation. So step 3, we want to determine a transaction price. We know that the transaction is a $250 per system, and we sold 1,000 system. So the transaction price in total is $250,000. And step 4 is to allocate the transaction price to each performance obligation, stand-alone selling prices. So this is a hard part kicks in. Okay. So the transaction price for one TrueBox, the system, is $250. But if we only buy the module, the plastic operator, it's worth $240. But if we only buy the subscription of the website, and then that's $60. So the TrueBox module is gonna be $250 transaction price, is 80% allocating to the TrueBox module and 20% allocating to TrueNet subscription. So the 80% here, how do we calculate the 80%? we want to use the plastic singular standalone selling price dividing the standing alone. If we buy things standing alone, adding two together is $300. So that means that 250 is 80% of the selling prices of the $250. And then if a standalone, the $60 will be 300. It will be 20% of the prices. Hence, that if we sell them in total of 250, then only 20% of the 250 allocating to the subscription. In another word, to allocating the price to each performance obligation, we wanted to look at their standalone selling prices and find out the proportion of the standalone of each obligation, how much was the allocation to the each obligation is based on the percentage of standalone price, right? Okay, so that's good. And then step 5, we want to recognize the revenue as each performance obligation is satisfied. So first of all, on January 2021, TrueTech recorded revenue from TreeBox module, but defers the revenue for the TreeNet subscription because the subscription is 1 year ahead of time, right? So therefore, we debit accounts receivable because they didn't pay us right away, but we performed the portion of the obligation. Which portion we performed? Of course, the operator, right? The plastic operator we perform, because the moment that we sell this operator, at the same time we sell the subscription, the plastic operator, which is 80% of 250,000, is already transferred at that time, at the point of transfer. However, this 20% of the $250,000 is a $50,000. This is based on the subscription, which should consider as a deferred revenue because the people hasn't used the website yet, right? Okay, exactly. So the $200,000 is standing for the plastic module, right? And then the TreeNet subscription of $50,000 is going to be the deferred revenue portion. So if you look at the T account, the deferred revenue is credited by $50,000 at the beginning. And then in each of the following of the 12 months, right, of the sale, following the sale, following the elapse of the time, meaning the time is passing by, the TrueTech record the following entry to recognize the TreeNet subscription revenue, which we will debit the deferred revenue and credit service revenue because people are enjoying the website month by month. So each month is going to be $4,167, right? Okay. So then I wanted to give us a summarization of what we have talked about. First of all, we wanted to identify the contract between seller and the buyer, right? The contract established the legal rights and obligation of a seller and a customer with respect to one or multiple performances. And second steps is we wanted to identify the performance obligation. A performance obligation is a promise to transfer goods or services that is distinct, which is the case if the goods and services is both capable of being distinct or separately identifiable, right? And 3, we want to determine the transaction price, means the transaction price is the amount the seller is entitled to receive from the customer in general, in the whole thing. And then we wanted to allocate the transaction price to each obligation. Basically, the seller allocates the transaction price to performance obligation based on stand-alone selling prices of the goods or services in each performance obligation. Okay, this is very important. And then 5th thing is that we want to recognize revenue when each obligation is satisfied. Hence that there's a different scenario here. If a seller can recognize revenue at a point of time when the control passed to the customer, which most likely if the customer first of all have an obligation to pay the seller, or is holding the legal title of the asset, or possess of the asset, or assume the risk worth of the ownership, or accept the asset. And the seller, second scenario is the seller will recognize revenue over a period is if the customer consumes the benefits as its work performed, or the customer control the assets as it's created. And the third scenario is that the seller is creating an asset that has no other use to the seller, and the seller has a right to receive the payments for when it's completed. Okay. Okay, so this is a great summarization of what I have learned in part 1, part A. Okay, so let's look at part B. Part B is related to, remember, the special issues in the revenue recognition. So part B, we wanted to know, first of all, we wanted to know what is the specific requirement for the contract to be exist. Okay. Second, we wanted to know what if we're dealing with prepayments, warranties, and customer options for additional goods and services. How do we deciding the obligation performance, right? Performance obligation. The step 3 is the related special issue is what if there's a variable consideration, means that is contingent on certain event happen, we will have a totally different transaction price, such as a right of return, seller as a principal or agent, and the time value of the money or payment by seller to the customers, right? And the step 4, we wanted to consider how does various approaches to estimating the standalone selling prices, right? How do we allocate the standalone prices based on, how do we allocate the transaction price based on the standalone selling prices? And step 4, step 5, how do we recognize licenses? How do we recognize a franchise? How do we recognize bill and hold arrangements and confinement arrangements or gift cards? And then disclosure, how do we disclose this in the income statement? And then there's a lot of special issues that we need to deal with. Okay, on each steps there's a special consideration that we need to consider. Okay, so first of all, special issues related to the step 1, which is how do we identify a contract. So a contract can be explicit or implicit, oral or written, right? So a contract, what do we say a contract, a sale contract or purchase contract exists is when it has a commercial substance, right? It's not something charity for free. Second, it has been proved by both seller and customer. If seller is the only person think that he's selling, then that's not a contract. If a customer is the only party that consider is buying, then that's not a contract as well. It has to be mutually approved. Okay. And 3, there is a specified in the contract is specify the rights of the seller and the customer. Who do what, right? The customer cannot be the seller or at one point in time, and the seller cannot become a customer at one point in time. And then also it's clearly specified the payment term. What is the payment? How does it get paid? What would be the way that does the seller pay how does the customer pay the seller? And the last one is it's probable that the seller will collect the amount it is entitled to receive under the contract. Another way is that if you find that there is a buyer, the contract is built on the condition that the customer can never afford that the things that was talked about from 1 to 4, it's still not a contract, right? For example, we can say the Mona Lisa is very commercial, has commercial substance, and then me and my friend talk about, okay, I want to buy, and then the friend say, yeah, I want to sell you as well, and then we can specify who is the seller, who is the buyer. Yes, it's clear, and then we can say, well, it's worth $1 billion. Okay, so but at the same time, the seller will never able to collecting the money from me because I can never afford that, right? So that's just a very interesting, like a silly example that I give you, just to remember what is the component of a contract. And what I wanted to emphasize is that a contract does not exist if neither seller or customer has performed any obligation under the contract. Okay, or both seller and the customers can terminate the contract without a penalty. So if you find that neither seller or customer has ever performed any obligation on the contract, then that means this contract has never existed. Or both seller and customer can terminate the contract without a penalty. That's not considered as a contract, because if both seller and the customer can terminate the contract without a penalty, that means this violate, right, the rights and the probability of the seller to collecting money. So if a customer can always canceling, terminate the contract without being penalty, then that means that there's no obligation from customer towards the seller who needs to pay for it. If a seller all of a sudden decided not to perform without any penalty, that means the seller does not have a real obligation towards the customer. So it's like some sort of logic argument here, right? Okay. And let's look at this one. So let's look at a simple example. Okay, ComStores ordered 1,000 tray boxes on December 20th, 2020 at a price of $250 per unit, and assume that ComStore and TrueTag can cancel, okay, the order without penalty prior delivery. Hence, that there's no contract, right? It's immediately. Okay. The TrueTag made a delivery on January 1st, 2021, and received $250 on January 25th, 2021. When does the TrueTag arrangement with ComStore qualify a contract with purpose of revenue recognition? Okay, so here, when January 1st, okay, the delivery is happening, that's when the contract exists, not December 20th, 2020. Okay. The reason is that even though the customers ordered the Trio box, but the emphasis here is saying that assume a ComStore and TrueTag can cancel the order without a penalty of delivery. So that means that the December 20th so-called transactions is not a contract. Okay. But when the TrueTag made the delivery on January 1st, 2020, and do receive the money, and then receive the money on January 25th, when the deliveries happened, then this is considered as a contract. Okay. Prior to delivery, neither TrueTag nor ComStores have performed an obligation under the contract, right? And both parties could cancel order without any penalty. So the arrangement did not qualify as a contract purpose of recognition on December 20. Okay, previously that we saw that the promise to providing goods and services are treated as performance obligation, right? The special issue we want to talk about on the step 2. Okay, when the goods and services are distinct. So now let's consider several aspects of contracts that we often encounter and determine if quality as a performance obligation. Okay, so for example, the following are not viewed as a performance obligation. Prepayments are not part of transaction price. Okay, quality assurance warranty, part of a performance obligation to be delivered products of acceptable quality. Okay, and right of return represents a potential failure to satisfy the original performance obligation to providing goods to the customer who wants to keep. So in other words, these 3 component cannot be considered as performance obligation. Okay. Prepayment is a part of the transaction price, right? And quality assurance warranty is considered part of the performance obligation to deliver the products of acceptable quality. And right of return represents the potential failure to satisfy original performance obligation. We don't consider, first of all, why we don't consider prepayments as performance obligation is because they are not a promise to transfer a product or services to customer. Instead, the upfront fee is an advancement of payment by the customer for future products and services and should be included in the transaction price, okay, and allocated to various performance obligations in the contract, initially recorded as deferred revenue. And recognized as revenue as when the performance obligation is being performed. The quality assurance warranty, sometimes we call the assurance type of warranty, is not a performance obligation. Rather, it is a cost of satisfying performance obligation to deliver products and of acceptable quality. So this, in other words, if you cannot, quality assurance warranty means that I will deliver the product to a quality that is acceptable, that we agreed upon. This is not obligation. It's not something that you can choose not to do. So basically, it's a cost of you providing the products. Okay, and the rights of return. Rights of return, these are the part of performance obligation to deliver the goods and services that the customer wants to keep, right? And they are viewed as a type of variable consideration. The transaction price is adjusted to account for them. Okay. So identify performance obligation. What is the performance obligation then? Okay, the following are viewed as a performance obligation. First one, extended warranty. Extended warranty is a warranty that extended if either the customer has option to purchase the warranty separately, or the warranty provides a services to the customer beyond the quality of assurance, right? This performance obligation can be considered as something that we can recognize revenues, okay? And options. Options means that providing a material right. A material right is something that customer would not receive otherwise, so the seller is obligated to providing it. In other words, first of all, extended warranty provides the protection that beyond the manufacturer's quality assurance warranty, and it's constituted a performance obligation, can be viewed as a separate transaction, okay? And the price is recorded as a deferred revenue, and then recognized as revenue. And this extended warranty, first of all, customer has option to choose not to buy it or buy it. And second thing, the warranty providing services customer to beyond the quality that it was assured, okay? And then the option here meant that option granted the customer to receive additional goods and services at no cost, okay, or at a discount, also qualifies as a performance obligation. And this can be software upgrades, right? Customized customers loyalty program, discount on future goods and services, and contract renewable options. Options for additional goods and services are considered a performance obligation if they provide material right to the customer that customer would not receive otherwise. Okay, it's something that upgrading the enjoyment or the consumption of the customer. And when the contract includes the option that provides material right, the seller must allocate part of the contract price to the option. Okay, and just like For other performance obligation, the allocation process requires sellers to estimate the standalone selling price of the option and taking into account that the likelihood of the customer will actually exercise the option, right? The seller recognizes revenue associated with option where the option is exercise expires. Okay. So only two, right? Extended warranty and options. So let's look at the first one, extended warranty. So the TrueTech offers a promotion coupon, okay, with every tree box it sells for $240. And the coupon, first of all, gives the tree box customer an opportunity to buy a headset that normally sells for $150 and only for $90. So in other words, if you buy the tree box, which is the plastic operator, for $240, it will give you a coupon. Okay, this coupon then give the customer an options. Okay, this is option scenario. Give an option to buy the headsets. Okay, the headset you normally sell at $150, but with the coupon it's only $90, which means that 40% of discount. The coupon must be redeemed within 1 year of the tree box purchase. The TrueTech estimates that 80% of the customer will take advantage of the coupon. And how would TrueTech account for the cash sale of 100 tree boxes sold under the promotion on the January 1st, 2021? Okay, so first of all, we wanted to consider the standalone selling price of the coupon, right? Is there this is the option here, so the option has a standalone price. And then with this standalone price, we can allocate the transaction price. We want to find a percentage to allocate the transaction price. The transaction price is this here is $240 for each, right? So therefore, how do we do that? Okay. First of all, the discount we know already is actually the coupon itself give $60 of discount, right? Why is that? Because it's only $150 minus 90 is a 60, or you can use 150 multiple 40% is $60. So the coupon itself is worth $60. Okay. And at the same time, you have to also estimating that the probability of this coupon being used by the customer. So then you have to multiply the probability of usage, okay? Because we're trying to recognize the revenue at the beginning, right? Before we know anything, we know whether people come to, whether people come back to use it or not. So therefore, we need to consider the probability of they can, and then the question told us that it's 80% of opportunity that they will come. So therefore, we want to use the coupons coupons worth, the worth of the coupon multiple the probability of the coupon being used. And then people sometimes ask, why do we need to multiply this 80%? The 80% is because that we want to estimate the standalone price. Hence that we have to consider the likelihood of this $60 happen or not. And then we know that this $60 will happen only 80% of the time. Hence that the standalone price is only $48. And then we wanted to estimating the standalone selling prices between this thing. So right, we are selling the tree box. So the tree box standalone price is $240, and this is the coupon standalone price. So the total is $288. So we wanted to allocate the standalone price to the transaction price, right? So the allocation will be 240 divided 288 will be tree box, which is a 5 6, right? And and then the coupon will stand for 1/6% or 16.67% of the whole performance obligation, right? And then how do we do it? We wanted to multiple the transaction price. Remember, the transaction price here right now is only $240 multiple 100, because this coupon is given with the module, right, with the plastic module. So that means that there's no one gonna pay you extra money for $48 or $60 whatsoever. You give the coupon with the module, and then your obligation is done. Hence that the transaction price here, the agreed transaction price of the whole transaction is only the $240 multiple 100. So that's why the 5/6 is allocated to the module, the plastic box operator, and then 1/6 is allocated to the coupon. So added up together is $24,000. So how do we do that? We wanted to debit $224,000, and then we recognize the sales revenue for the tri-box module, the plastic operator, for $20,000, and then we want to credit the deferred revenue because we have not find out whether people use it or not. People use the coupon or not, right? The coupon will be used when they come to buy the headset. When they buy headset, we recognize the coupon revenue. Okay, so let's look at this question together. So sales corporation offers a promotion coupon with every product it sells. The coupon gives the sales corporation customer an opportunity to buy an electric drill that normally sells for $50, okay, only for $30, so that coupon is $20, right? And then the coupon must be redeemed within 1 year of the purchase. The sales corporation estimated that 80% we have to consider the estimation of probability. So the standard alone price for the coupon is only $16, right? Okay. Okay, so second, the Hooper Inc. Offers a discount on extended warranty, okay, on its iPhone. And when the warranty is purchased at the time the iPhone is purchased. So basically, this is a standard for the first scenario of warranty. Remember, there's two. One is option, like a coupon, or second one is the warranty, right? And this warranty is something promised like beyond the current quality, or purchased to the quality of delivery is one thing, but the extended warranty is give you benefit beyond the agreed upon quality, right? And you needed to pay for it too. And the warranty normally had the price of $30, but Hooper offers it for $240 when purchased along with the iPhone. And Hooper anticipates 75% of the chances the customer will purchase the extended warranty along with the iPhone. Assume that Hooper sells 1,000 iPhones with extended warranty discount offer. And what is the total standalone selling price that Hooper used for the extended warranty discount option for purpose of allocating revenue among performance obligation in those 1,000 iPhone contracts? So basically here, the standalone transaction of the coupon, right? The question is how what Hooper will use for extended warranty discount option, right? For purpose of allocating the revenue among the performance obligation. So we want to the $60 of discount, right? Because $300 minus $240 is gonna be the discount, right? So the discount has a 75% 5% chances to be used. Okay. And then, so the standalone price of the option provided with 1,000 iPhone should be 60 multiple 75 multiple 1,000, and then it's equals 45,000. So it's choose C. In other words, the warranty, the discount, so this discount, right? So how does this option worth? How much is this option worth? So when you buy the iPhone, I give you discount to buy the warranty, right? So this discount will give you the warranty normal selling at $300 to $240. So therefore, this discount is worth of $60, right? And then they said that there's a 70% of chance that the people will take advantage of this discount. Hence, that we wanted to calculating the likelihood of using this discount. And since there is 1,000 iPhone will be sold, company with this sort of discount offer, so therefore we want a multiple 1,000. And then the standalone consideration of this discount, warranty discount, is gonna be $45,000. Okay, so let's look at the special issue for consideration step 3, which is determining the transaction price. And then here we wanted to have a little bit of complication. The complication will be estimating the transaction price involve the variety of consideration. It's including A, variable consideration means and the constraints on its recognition, right? And then B, sell with a right of return. How do we deal with this kind of way? So determining transaction price means that how much this contract really worth, or how much how much in total that seller really expected to get paid, right? That's the total amount of the seller expected to get paid. And then there's a variable consideration involved. Say, so the first one is a variable consideration and the constraint on its recognition. Sometimes it's saying that you cannot recognize until certain things happen. B is a sell with a right of return. So if you sell something, you say that, well, you can return it if you don't satisfy, right? So how do we do that? And C is identify whether the seller is acting as a principal or agent. Sometimes the seller, the so-called seller, the contractor with the customer is basically an agent instead of the principal. Principal is the ones who really providing the products. Agent is the one who charging the median fee. For example, a real estate agent, right? The seller is the house owner. So the house owner will go to real estate agent to sell to the customer. So the ones who are buying is actually look like they are buying from the real estate agent, but actually they are buying house from the house owner. So this is a complication when we encounter. So how much the agent really make out of this deal, and how much the house owner really make from this deal. We needed to identify who is the seller here, right? And also we want to consider the time value of money. A lot of times the payment itself maybe is 3-4 years from now on. So the chapter 5 we talk about how to discounting the future prices to current price. So this is another thing that we consider what is the seller's real expected amount to get paid for. And then E is that payment by seller to the customer, right? Sometimes the seller needed to refund the customer money based on certain event. Then how do we consider that part of the payment, the impact on the transaction price? And so first of all, we want to consider variable consideration. So what is a variable consideration? It means that a proportion of the transaction price depends on the outcome of a future event. For example, construction is an incentive payment, right? So if you can finish this within 3 months, I give you certain more money. If you have to drag it to half year, then that incentive is gone. Second, entertainment and media, such as royalty, right? And three is that the healthcare, so Medicare and Medicaid reimbursement, and manufacturing volume discount and product returns, and telecommunication rebates, right? So the method of estimation, there's two methods. One is called expected value, and one is called the most likely amount. So we wanted to introduce both this scenario. And then third is a select method based on the ability of best to predict the amount that seller will receive, right? So how do we choose? We use expected value or most likely. It's depending on you wanted to choose based on the ability of your prediction. If you can predict the which most likely, then you choose which method to estimate the transaction price. Okay, so determine the transaction price. Let's see an example. The TrueTech enters into a contract with the Pro Sport Gaming to add the Pro Sports Online Gaming to the TreeNet network, right? So the Pro Sports offers a popular game like Brawl of Bands, and wants those games offered on the TreeNet. So the Pro Sports can sell gems, weapon, and health options, and other game features that allow player to advance more quickly in a game. So basically, Pro Sports wanted to join the TreeNet network. So for example, this example, it's like Amazon wanted to join Hulu, right, to sell products on Hulu, basically. And then because Amazon can offer more products through different kind of products, right? Can sell the gems, can sell weapons, and stuff like that. And so the term of the contract is very interesting. It's here. It's saying in January 1st, the Pro Sports pays the TrueTech an upfront fixed fee of $300,000 for 6 months of featured access. Second, the Pro Sports also pay TrueTech a bonus of $180,000 if the TreeNet users access the Pro Sports games for at least 15,000 hours during 6 months period. So in other words, to secure this contract, right? So the Pro Sport paying, so this is gonna be the customer, and then TrueTech is gonna be the seller, right? So the TrueTech gonna receive $300,000 as a prepayment, okay? And then also if the TrueTech customer using the service of a Pro Sports for more than $15,000 hours, and then the TrueTech company can also recognize another $180,000. How do we do this? So the TrueTech estimated that the 75% of chance their users will achieve the usage target for and receive $180,000 bonus. So then the question is how much money the TrueTech really can make from this transaction. Then that's why we call it transaction pricing, right? So basically, first of all, what I wanted to say is that when you receive this $300,000 fixed payment in the beginning, you definitely want to debit cash and crediting deferred revenue, right? And then you will, because this $300,000 is worth 6 months, so you will recognize that gradually when the Pro Sports using your platform over the six months, then you gradually recognize as your revenue, okay? And then so what do we do about this bonus thing then? It's depending on the future event. If my customer using their services for $15,000 hours, then I can recognize my $180,000. So then we have the first alternative is to using the expected value. So expected value is considered the probability of a revenue stream. So there's a 75% of chances that the TrueTech can make 480,000. Why is that? Because the 180,000 plus the 300,000, right? 300,000 they definitely can make because it's already recognized as a deferred revenue. And the 180 means that the customer definitely can play the game from pro sport for more than 150 hours. So, but this likelihood is only 75%. And another 20% of the likelihood is only we fail to get that $180,000. We only played less than 150 hours, right? So therefore, if we multiply this likelihood, then we can find out that the expected transaction value, transaction price, contract price is a $435,000 considering two likelihood. This is alternative one to decide how much is transaction price. Alternative two is we just using most likely amount, right? So what is the most likely? Most likely is what is the high likelihood of this thing? What is likely? How likely we can enjoy this $180,000? 75%. That's a high likelihood, right? So that means that why don't we just directly recognize it? We directly recognize this deferred revenue for $50,000 and then bonus the why don't we just recognize it? For example, the first month we write down the deferred revenue because it's the $50,000, 300. This equals to 300,000 dividing 6 is $50,000, and then we just recognize it. So 180,000 dividing 6 is $30,000 because 75% is very likely, is the most likely scenario. Hence, during the first months, we just bravely recognize it. Debit deferred revenue, debit bonus receivable, and credit service revenue, right? And then we do that. So say for 6 months, okay? And then that's another alternative. We can do this. So, and then what if the TrueTech really received the bonus? Then we just debit cash and then we credit out all the bonus receivable. And then here you go. We got the money. We recognize the revenue already, right? Service revenue already recognized along the way because we consider this is very likely to happen. So we just recognize it. And then at the end of the 6 months, we did receive the bonus that we just transfer this $30,000 out from the receivable account. And if a TrueTech does not receive the bonus, then simply we just spit it out, right? What we do is that we debiting our service revenue that is associated with the bonus part, and then we reduce the receivable for $180,000. Okay, so this is a second alternative, is the most likely alternative. Okay, so what if we assume that after 3 months, the TrueTech concludes that due to low usage of a pro sports game, the most likely outcome is that it will not receive the $180,000 bonus. So basically, we just using the most likely way to recognizing the revenue by debiting the deferred revenue for $50,000 equals the 300,000 dividing 6, and then also we recognize bonus revenue, bonus receivable for $30,000 is because $180,000 dividing 6, right? And then crediting the service revenue from January to March. Okay, so first 3 months, but by April we find out that the likelihood of we receive the bonus is dim. So that means that we're not likely to receive it. So no worry. So what we will do is we reverse the bonus receivable. We just take out the things that we think we're not gonna making it, right? So what we do is we reduce the service revenue for the 3 months of bonus that we thought we can get, which is $30,000, $90,000. We reverse this revenue, right? And we're crediting out all the bonus revenue, bonus receivable that we have been recognizing for the 3 months. And then in end of the April, what do? We just only recognize the deferred revenue for $50,000, right? And then we're crediting the service revenue for $50,000. Because on the April to say June, we only do this. By April that we reverse what we have done, right? Okay, that's another way to do it. Okay. Okay. So for the remainder, okay, of the contract, the TrueTech only recognizes the revenue each month associated with upfront fixed payment of $300,000, right? Okay. Very good. Let's look at this example, okay? So Cindy enters into a contract offering variable consideration. The contract pays Cindy $200,000 a month for 6 months for continuous consulting services. In addition, there is a 60% chances the contract will pay additional $4,000 and a 40% chances the contract will pay additional $6,000. Depending on outcome of consulting contract, Cindy conclude that this contract qualifies revenue recognition over time. Assume that Cindy estimates the variable considerations as the most likely amount. What is the amount of revenue Cindy would recognize for the first month of the contract? Okay, very good. So this means that if it's the most likely scenario, then that means that the 60% of time chance that we can get a $4,000, right? And 40% of chance that we can get $6,000. So most likely we'll pick the 60%. So therefore, we wanted to use 60%, right? So basically, we wanted to use $2,000 multiple 6, right? Because since $2,000 is for sure plus $4,000, right? This is the most likely, right? 60% most likely. And then this will equals to $16,000, right? And then $16,000, this adds a $16,000 over 6 period. So each period is going to be 2,667, right? Okay. And then let's look at another question. So same question. Cindy enters a contract offering variable consideration. Same thing, right? $2,000 for sure for 6 months, and 60% of getting extra payment for $4,000, and 40% getting paid for $6,000. And then this time instead, for the most likely case, and then they want us to use the expected value case. So what we will do is a $2,000 multiple 6 plus. So if it's 60% of chances is $4,000 and 40% of chances is $6,000. So that means that we will have this is add up equals $16,800, right? And then if you use 16,800 dividing 6, then you can get $2,880. So therefore, 2,800. So that will be this one. Okay. So I think now you probably kind of get idea about what is a variable consideration. Okay. Special issue 3. Still the step 3, right? What is the consideration price? What is the transaction price? And then the third, there's another scenario is called constraints on the recognizing variable constraints. Constraint means that something stop you to do something. So specifically, it means the seller only includes an estimate of variable consideration in the transaction price to the extent it is probable that a significant revenue reversal will not occur when the uncertainty associated with the variable consideration is resolved. In other words, so let's say use that the option saying that if the coupon saying if the bonus, remember that $180,000 bonus scenario, right? It says 75% of chance. So at the beginning, we can already consider this as a different way to recognize it, right? But this means the constraint on recognizing means that you have to have there's a condition in a contract saying that once it's probable that significant revenue reversal will not occur when the uncertainty associated with the variable consideration is resolved. So we know there is a variable consideration of $180,000 bonus, but the probability of this happening or not is needed to be determined or probable. The probability of this consideration is resolved, then we can recognize it. Okay, so what kind of indicator saying that significant revenue reversal would happen? For first of all, poor evidence on which to base an estimate. 2, depends on the estimate on a factor outside the seller's control. 3, a history of seller changing payment terms on a similar contract. 4, a broad range of outcomes that could occur. And 5, a long delay before uncertainty resolves. So all these things means that you cannot use the bonus calculation at the beginning. Means that there's a constraint for you to recognize this, consider this transaction price at all. For example, you have a poor evidence on which to base on your estimation, or depends on the estimation of factors outside of your control, or you have a history that changing payments term, and also the broad range of outcome could occur. So therefore, this bonus thing you just don't even need to consider at the beginning until all these things are resolved clear. Then you can consider it. Okay, because the applying the constraints requires a judgment on part of the seller to take into account of all information available, right? The indicators that a significant revenue reversal would occur, right? So in all of these following scenario, there could be a significant revenue reversal. Hence, that you don't need to consider this offering at all, okay? Because the reversal will causing more complications. So even though there's a possibility, 75% of possibility that you will earn bonus of 180, because this sort of a significant revenue reversal will happen, you don't consider it. If a seller changes opinion regarding whether the constraints on the variable consideration is necessary, the seller should update the transaction price in current reporting period, just as the seller would do for other changes in estimated variable consideration. So this one, I wanted to do a really good explanation. Okay, so for example, assume that TrueTech cannot conclude that it's probable that the significant revenue reversal would not occur in the future. So in other words, that TrueTech does not really know whether the revenue can really make in the future. It does not really have a certainty that the revenue will not reverse. Then what? Then the TrueTech only recognize the revenue about the upfront fee. Okay, the TrueTech is constrained from recognizing revenue associated with variable consideration that $180,000. He is constrained, means that he cannot recognizing it because he cannot conclude the probability of reversal. And then so therefore TrueTech only include upfront fixed payment of $300,000 in the transaction price, and recognize only $50,000 each month. Okay, so what if on April 1st, after 3 months of a contract has been passing by, TrueTech conclude that he is now can make accurate enough bonus estimation for it to be probable that a significant revenue reversal will not occur. So it means that he's sure now about that $180,000. So then they can estimate the likelihood of receiving the bonus. So in exactly the same way we do, right? So it's just catch up the missing period. What does that mean? Means that if you know that you are very likely to receive that by April 1st, that means from January 1st to March 31st, you should already recognize $30,000 of the bonus, right? Now you know it's sure. Then you have to catch up the missing period by debiting the bonus receivable of $180,000 out of the 3 months that you didn't do, and then crediting the service revenue of $90,000, right? And then for the rest of the 3 months, okay, then you just recognizing as a month by month deferred revenue for $50,000 transfer out, and the bonus receivable for only $30,000 for each month for $80,000 revenue from April to June. Okay. So another scenario here that we want to talk about is if you have a right of return in your contract, then what would be the transaction price of your contract, right? What is a right of return? Right of return exists when the customer can return the goods if not satisfied or unable to resell it, and or it's viewed as a failure to satisfy the original performance obligation, or sellers reports net sale revenue in the income statements and equals to the gross revenue less than actual and estimated return. Okay, so let's look at this example. So assume that TrueTech sold 1,000 the plastic operator for tray boxes for comp store for $240 each. The TrueTech estimate that the comp store will return 5% of the true boxes purchases. So that means that the net sale of this transaction should only be $228,000 because you want to consider the rate of the return prices, right? Because $240,000 multiple 5% is going to be $12,000. So the net sale is going to be $220,000. Okay. And the next thing, the last thing that we want to consider is who is a principal and who is agent, because the principal agent can only recognize the transaction part of transaction fee, and the agent can recognize the revenue that belonging to the selling of the goods. What does I meant? Okay, so first of all, principal is different from agent. The performance obligation from principal is to providing the goods and services, so it is vulnerable to the risk associated with holding the inventory. However, agent is the only person to facilitate the transaction between principal and the customer. Let us use the real estate agent for example, right? The owner of the houses are the ones who suffer or who will be vulnerable associated with the risk of holding the house when the house price is going down. However, agent does not endure that risks because he is only facilitator to link the principal, which is the seller of the house, to the buyer of the house, right? So the performance obligation here is different. And then when we're recording the revenues, the total sale price, principal will recognize the total sale price to the customer and also recognize the cost of the goods sold. For example, you will recognizing the original house cost, and then you will recognize the sale price as your revenue. but the agent only recognizes the commission that received as a transaction price, right? So in other words, that if you're a real estate agent, you only make the commission, which is the 10% to 20% of the sell fees, right? Okay, so let's look at an example. Mike buys a Trailbox module from online retailer for $290. Let's consider accounting for the sale by two retailers, Prinko and AgentCo. Okay, Prinko purchased a Trailbox module directly from TrueTech for $240. Has a module shipped to the distribution center in Kansas, and then shipped to individual modules to the buyer when the sale is made. So Prinko offers occasional price discount according to the marketing strategy. AgentCo serves as a web portal by which the multiple game module manufacturer like TrueTech can offer priced product for sale. The manufacturer ships directly to the buyer when the sale is made, and AgentCo receives $50 commission on each sales that occur via its web portal. So in other words, AgentCo is acting like eBay, right? eBay does not have any people sell that. eBay's sellers eBay sellers actually are the one who actually the agent, but eBay itself is actually agent allow people to sell and buy on the web. So therefore, Prinko is qualified as a principal, and AgentCo is qualified as agent. So therefore, Prinko, when it recognizes revenue, the revenue should be $290, right? When it sell. And the cost of goods sold should be the purchase price from the TrueTech. So therefore, the gross profit for Prinko is $50. As long as the AgentCo, the revenue here is $50 because it's only the commission fee, right? And then the gross profit is $50. Okay. So let's do a concept check. Clayton Consulting operates a website that links experienced statistician with business that needs data analyzed. The statistician posted their rates, qualification, and reference on the website, and Clayton received 25% of fee paid to the statistician in exchanging of identified potential customer. Lovelace Associates contacts Clayton, arranging to pay $4,500 in exchanging of analyzing some data. Clayton's income statement would include the following with respect to its transaction: revenue of $4,500, revenue of $4,500 and cost of revenue of $33.75, or revenue of $11,112, or revenue of $5,600, cost of $4,500. So the answer here is very clear, right? It should be only this one, because the Clayton is only a website, right, that allows statistician offer their services. If the contract is $4,500 and they only taking 25% of fee, then that should be the revenue of Clayton. Okay. And then the next thing we want to consider the transaction price consideration is time value of the money. So if time value of the money is a significant part of the contract, then seller should view the transaction price as consisting of two components. First of all, the delivery component and the financing component. Delivery component means equals the cash price of the good of the services. And the financing component, which is the interest considered paid to the customer in case of the prepayment, or to the seller, right, in case of receivable. So seller can assume the financing component is not significant if period between the delivery and payment is less than a year. So if no matter you get a prepayment from someone or you wanted to receive money from someone, if this period is less than 1 year, then the financing component is negligible, right? But if it's more than 1 year, say 10 years, then the financing portion of this payment need to be considered. Okay, let's look at an example. So on January 1st, TrueTech enters into a contract with GameStop store and deliver $250 for Trailbox module that had combined a fair value of $960. Okay, So the prepayment case is that the GameStop pays TrueTech $873 on January 1st, okay, and 2021, and the TrueTech agrees to deliver module on December 31st, 2021. And what this means that when you deliver a cash, you know that the worth amount the module worth $960. However, TrueTech only get paid $873 because 1 year of 1 year interest on $873 can grow to $960, or you can calculating by using the future value of $960 multiple the present value of interest rate at 10% and the number 1 period, and then you can find out that the TrueTech right now can only recognizing $873 as revenue and crediting deferred revenue, okay, for $873. Okay, so when is a subsequent delivery occurs, that means that the TrueTech is making interest, right? So therefore, the sales revenue can grow to $960, and the deferred revenue is $873 plus the interest expenses for $83, right? In other words, so you holding this cash for $873 and you put them into the bank, right? And then therefore this interest expenses can be considered the expenses to generate to supporting this transaction. At the same time, you are making $960 as a total revenue, and you reverse the deferred revenue for $873. So TrueTech views that the financing component to be significant. The applicable interest rate is 10%. Okay, so what if another way? So on January 1st, the TrueTech enters into a contract with GameStop and then to deliver $240 four TrueTech box, each is $240. That combined fair value is $960, right? And then receivable case. Before that one is a prepaid case. Now we are receivable case. TrueTech delivers module on January 1st, and the GameStop agrees to pay TrueTech $1,056 on December 31st, 2021. Okay. So see this last what is called a prepayment case is because the GameStop paid the TrueTech at $873 on the day one, right? So therefore you debit cash and credit deferred revenue, and TrueTech delivered the module at the end of the year. That's why you wanted to credit the deferred revenue. At the same time, by the time you deliver, which is December 31st, 2021, you recognize your revenue for $960, but also you wanted to reverse the deferred revenue and debit the interest expenses. But what if the TrueTech delivers at the year one, the beginning of the year, and then the GameStop pay later? So the first thing is that you want to debit notes receivable, right, for $1,050, and you credit discount notes payable for $96, and credit sales revenue for $960, right? First of all, you know that you're gonna receive $1,050 in the future, right? And then the discount that you having, you will discount for $96 because the true value of the transaction price is actually $960, right? And then when the subsequent you collecting the money of $1,556, you will debiting cash, and you will recognize the revenue of $96, right? and you will credit out your notes receivable, and then you will write off the discount of notes receivable. So this too is washed off, right? And then you recognize the revenue of 1,000, receivable of $1,056, and cash for 1,000, received cash for 1,050. Your real revenue, okay, still $960. The rest of this calculation is the only financing part of it. Okay. Okay. So there's the last thing we want to talk about is the payment by the seller to the customer. So payment by the seller to customer is like rebates. So if the seller purchases distinct goods or services from the customer, first of all, at the fair value of those goods and services, the seller accounts for that purchase as a separate contract transaction. Okay. And then 2, pay more than the fair value of those goods or services. Those excessive payments are viewed as a refund. So if you find that the seller buys things from a customer, if the purchase prices, fair prices, can be viewed as a separately distinctable, that means that it can be viewed as a separate transaction, right? Second of all, if you find the fair value of those goods and services excessive than the seller's original selling price, then you can view that excessive payment as refund, which is going to be subtracted from the amount the seller is entitled to receive when calculating transaction price of the sale to the customer. So let's look at the example. Okay, so basically, if the seller at the beginning agree to deliver product for $800, and then the seller will rebate $40. So that means that the transaction price here, it should only recognize the 760 because it's considered as a refund, right? If rebate means that you give money back to the customer. Okay. So now let's move on to the special cases for step 4, which is how do we allocate transaction prices to performance obligation. So there's a various approaches available to estimate the standalone selling prices. First one, we can look at how to adjust the market assessment approach. Means that the price if the product and service was sold in the market. And the second one, we can look at expected cost plus the margin of the approach. Means that we estimate the cost of satisfying a performance obligation and then adding the appropriate price margin. And third scenario is that we want to use a residual approach. Means that subtract the sum of the known and estimate the standalone selling price from other products in a contract from the total transaction price of the contract. So 3 methods. And then I think I almost talk about 1 hour something. I think I will make another video starting from the special issue of the step 4. Thank you.